you can convey them to Mrs. On.
Assalamu alaikum. Good evening. This is the second day of session on accounting for fixed asset. Yesterday we covered International Accounting Standard 23 and International Accounting Standard 20. And today we shall start with International Accounting Standard 40. And thereafter we will discuss International Accounting Standard 16. And there is an interpretation related to International Financial Reporting Standard 16, IFRS 1. And we shall be discussing that interpretation in detail, because so far as the IFRS 16 is concerned, we will be only refreshing what we already know, like what is depreciation, devaluation, cost model. We will be going through that material. But so far as interpretation 1 is concerned, that is something which is of advanced level, which need to be learned, especially for those members who are working in such industry where the fixed assets, their fixed asset involve restoration and dismantling cost, and that interpretation will tell us how can we account for like these restoration and dismantling cost, especially in the context of the cost model as well as in the context of the devaluation model. I mean, if there is any change in the restoration cost and dismantling cost after initial measurement, what will be the treatment? And there are two types of treatment: one under cost model and other under revaluation model. So that is very important. I hope that we shall be able to discuss that interpretation during today's session. But if we could not, or if it is not fully discussed during today's session, then of course we will continue tomorrow as well, wherever we reach at the end of today's session. So let's start with the International Accounting Standard 40. International Accounting Standard 40. This is investment property. We should be careful because there are small changes in this standard as well. Investment property. Definition is the same, very small change within this definition. Investment property is property, land or building, or part of building or both, held by the owner or by the lessee as a right of use asset to earn rentals or for capital appreciation or both, rather than for use in the production or supply of goods or services, or for administrative purposes, or sale in the ordinary course of business. Then there is a definition of owner-occupied property. Is property held by the owner or by the lessee as a right of use, or for use in the production or supply of goods or services, or for administrative purposes. We know that International Accounting Standard 16 applies to owner-occupied property, and International Accounting Standard 40 will apply to the investment property. Okay, these are the examples of investment properties. Land held for long-term capital appreciation. Second, land held for a currently undetermined future use. You have a land, but so far you have not decided about its use. So standard says you will classify such a land as investment property. Third is building leased out under an operating lease. Building leased out under an operating lease. Why operating lease? See, we discussed International Financial Reporting Standard 16. In case of lessor, the standard retains the term finance and operating lease. When you rent out a building, you are a lessor. So that's why here it is used, building leased out under an operating lease. Vacant building held to be leased out under an operating lease. Then the last one is property that is being constructed or developed for future use as investment property. This is a small change. Before, this was not the case. Now, standard included the property which is being constructed or developed, that will be treated as investment property. And these are not investment property. Property intended for sale in the ordinary course of business or in the process of construction or development for such sale. Like if you are in the business of building houses, and you are building houses for sale with an intention to sell them in the future. So this is not; these are not your investment properties. Property held for future use as owner-occupied property. Owner-occupied property awaiting disposal. And then property occupied by employees, whether or not the employees pay rent at market rates. Property held for future development and subsequent use as owner-occupied property. Owner-occupied property awaiting disposal. Property that is leased to another entity under a finance lease. In the last slide, we saw the property which is leased to another party under operating lease. That property will be an investment property. But if the lease is finance lease, again I will remind you that why we are using the term finance lease, because in this case we are lessor, and even the new standard has retained the terms operating and finance lease so far as lessor accounting is concerned. So this slide is again very important practically. So you must have this list in mind while deciding about investment property. Okay. Other cases, for example, if a portion of a property is for rental and another portion for rental or capital appreciation, and another portion is held for use in the production or supply of goods or services, or for administrative purposes. I mean, you have a building, a portion of that building is being used as an owner-occupied property. Owner-occupied property means for use in the production or supply of goods or services or for administrative purposes. And a portion of that building is for rental or for capital appreciation. So how can we treat this building? I mean, if these portions can be sold separately or leased out separately under a finance lease, an entity accounts for the portions separately. If the portions could not be sold separately, the property is investment property only if an insignificant portion is held for use in the production or supply of goods or services or for administrative purposes. Mean if we cannot sell those portions separately, or if we cannot uh, rent out those portion under finance lease separately, then if owner occupied portion is insignificant, then the whole building will be, only then the whole building will be treated as investment property. Otherwise, this building will be treated as investment owner occupied property. Then, if an entity provides ancillary services to occupants of a property it holds, treat it as investment property if the services are insignificant to the arrangement as a whole. The example could be when the owner of an office building provides security and maintenance services to the lessee who occupy the building. So this is an example where ancillary services are insignificant. In this case, this property will be treated as investment property. Then if an entity owns property that is leased to its parent or another subsidiary, it is not investment property in group financial statement, but it is investment property in its individual financial statement. Other than this, like we have just discussed about like a building where owner is providing ancillary services. There we concluded that if ancillary services are insignificant, then that property will be treated as investment property. In other cases, the services provided are significant. For example, if an entity owns and manages a hotel, services provided to guests are significant to the arrangement as a whole. Therefore, an owner-managed hotel is owner-occupied property rather than investment property. Standard provides us guidance when it is difficult to assess significance. Then standard says one must apply the judgment in deciding whether the property should be treated as investment property. So this was all about investment property. If you people have any question regarding, because this discussion is very important. Once we are clear about this discussion, then we can move forward. And if you are not clear on any of these points, then of course, because the rest of the portion is not that much difficult. Okay, if you have any question, type it now, and then by the time we will be taking your question. Recognition, same criteria as we use in case of any other asset. Investment property should be recognized as an asset when two conditions are met. It is probable that the future economic benefits that are associated with the investment property will flow to the entity. And the cost of the investment property can be measured reliably. This is the general criteria which normally apply to each type of asset. Initial Mayman, do we have any questions so far?
No. Okay.
Yes.
Ravi Kumar has just popped up that question. Sir, we have labor accommodation business. We have 16 blocks. We also have catering business, which we also operate from same premises. Basement of 2 blocks are used for producing food like kitchen. So how we should treat the portion of the property?
How many floors are there in the building? Ravi, how many floors are there in the building?
He said 2 blocks.
2 blocks.
4 floors.
4 floors. And 2 floors are used for your own purpose? Yes or no?
Yes.
This means 2 floors out of 4 floors are being used as owner occupied property? Yes or no? Can we sell these?
Basically, he said these things are being used for catering business operations. These floors are used for catering business.
Okay, this means these two floors are being used as an owner occupied property. Ravi, yes or no? If you are using these two floors for catering business, this means you are using this part of this portion of the building, these two
Yes.
floors, owner occupied property.
Yeah.
And what about the rest of the two floors? Ravi,
About 2 floors, he said he has a kitchen over there
for
processing food.
the same thing he said, Ravi. Ravi, in 2 floors, you people are like you people have kitchen, and that kitchen is being used to supply your catering business. So this
The rest of the 2 floors are used for accommodation purposes.
accommodation of the employees. Accommodation of the employees. Ravi, if we go back to our earlier slide, here we have seen that property occupied by employees. This is not an investment property, and for the rest of the 2 floors, that is purely owner occupied properties. So the whole building will be owner occupied property. Ravi, I hope it should be clear, because 2 floors are with reference to the point number 4, which are mentioned in the slide, which is appearing now on the screen. And the second is that is purely owner occupied property, because that property is being used for the production, which is ultimately part of your overall catering business. Ravi, I hope it should be clear. Okay. If we have any question, otherwise we can move further.
Other portion is rented out to other clients, to our clients. Basically, Ravi, I must say that you should send complete details in one go. Otherwise, we have to look for the relevant details in bits and pieces. So the details in the answers could be like this as you receive from our trainer. You should properly put your question in one go, please.
Okay. Do we
Other
have
people are also
Yes, yes, yes.
asking questions.
Yes, please.
Okay, so we have a question from Yasir Khan. Do investment property to be recognized as fixed asset in both the subsidiary as well as in parent accounts if the property is rented to subsidiary?
If the property is rented to a subsidiary, in the subsidiary account, of course, this is not an investment property because this is not owned by the subsidiary. So far as the parent is concerned, in the consolidated account, this will not be an investment property. But in the separate parent account, this can be treated as investment property. Like, for example, subsidiary subsidiary like A Limited is a subsidiary of B Limited. B Limited is parent. In the separate financial statement of B Limited, this property will be investment property. But when B Limited prepares consolidated financial statement, then it cannot be treated as investment property, because in consolidated financial statement, subsidiary and parents are treated as one unit. So you cannot treat a property if it is being used within that particular setup. So in consolidated, that setup has become one. So that will not be an investment property in the consolidated financial statement. I suppose it should be there. Next.
Okay, so we have another question. In fact, Mariam Alauddin asked to kindly elaborate the point related to other cases.
Okay, other cases. We come to the other cases. Okay, other cases. Maria, which point? Like there are in fact 3 points. So if we can say 1, 2, 3. So which point or all points?
Last point as mentioned earlier.
Last point. If an entity owns property that is leased to its parent and or another subsidiary, it is not investment property in group financial statement, but it is investment property in its individual financial statement. See, property is owned by the subsidiary and it is leased. Say, first of all, we take just this parent. It is leased to the parent, of course, to earn rental. This means here subsidiary is earning rentals from the parent. When subsidiary will prepare its own individual financial statement, subsidiary will treat this property which is rented out to the parent as investment property. But when parent prepares consolidated financial statement, of course, within those financial statement, the financial statement of this individual subsidiary will also be consolidated. There, this property has become, for consolidated financial statement, this property belongs to that group and being used by the group. So that will become the owner-occupied property. Mariam, I hope it should be clear.
We have other question.
Mariam, I hope it should be. Mariam, can you ask Mariam, is it clear or not? Should we move?
Mariam, can you speak up in the chat box if it is clear to you now?
Okay, next. Take next question by the time she can answer.
Yasir Khan asking, do investment property to be recognized as fixed asset in both the subsidiary as well as in parent accounts? If the property is rented to subsidiary.
Yasir, I answered this question.
Okay. We have another question from Usman Yusuf. Please explain how investment property is not classified in group financial statement, but in investment property in individual financial statement.
Usman, in group financial statement, parent and subsidiaries are taken as a one. So as a one entity, as one entity. So if we just see that building is within that group and that building is used by this group, so this will become the owner-occupied property. But so far as the subsidiary individual financial statements are concerned, only related to that subsidiary. So in that financial statement, parent is a separate entity to whom they have given this building on rent. Usman, I hope it should be clear. Are we
running?
No problem.
Running fine. We are running fine.
Okay. Next question.
Next question is from Ali Naksh. Can you explain transfer of revalued property having revaluation gain from IS 16 to IS 40?
Who is
What will be the treatment of surplus?
Who is this gentleman?
Ali Naksh.
Ali Naksh, we shall be discussing this point with the help of a small illustration. Okay, next. Okay. Should I?
We have other questions as
yes,
well.
Please.
What will be the implication of IFRS 17 leases as with reference to finance lease versus operating leases? What will be the criteria for deciding finance versus operating lease for IS 40?
IFRS 60. I suppose IFRS 16.
IFRS 17 leases.
IFRS
IS 17
relates
leases.
to
I think
leases.
he is mistakenly saying.
Can you reword your question? Okay, next question. Next question.
Next question is from Aslan Rashid. How should we treat office operating lease from lesser perspective as an investment property?
Office operating lease.
Why they are putting questions of leases?
No, I can answer that. I understand why they are putting, because the definition of IAS 40 is affected by. Rather, I should say definition of the investment property is affected by the introduction of the IFRS 16.
Mariam replied, "Thank you, sir."
You're welcome. Okay, should we move further or do we have any more questions? Okay.
We have one more question.
Yes, please.
Why property occupied by employees paying market rent as it is earning rentals? As they are earning rentals, I think.
See, because this is being occupied by your employees, and employees are providing you the services, and they are part of your main business. Their services are part of your main business. So that's why standard is not allowing this type of building as an investment property. There is a good question related to leases. That's why I'm waiting for that rewording of that question.
Sukaina Fatma asking, I would like to confirm that in other cases, lease property either to parent or subsidiary is considered as operating lease. This question is not clear, I think.
Okay.
Another question from Abdul Qadir. If company have some specific premises for employee entertainment, how it will consider whether it be considered as an investment property?
Owner occupied property. Next.
Usman Yusuf, where to classify that rent amount received from employees?
Where to classify that?
Rent amount received from employees.
Other income. Next.
No.
Okay. Recognition we discussed. Initial measurement. Initial measurement. The cost of purchased of an investment property comprises its purchase price or any directly attributable expenditure. Directly attributable expenditure includes, for example, professional fee for legal services, property transfer taxes, and other transaction costs. So initially, it will be measured at cost. Then an investment property held by a lessee as a right of use asset shall be measured initially at its cost in accordance with IFRS 16. This is the initial measurement. Then is subsequent measurement. There are two models, we know. These are the same old models. This standard requires all entities to determine the fair value of the investment property for the purpose of either measurement, if the entity uses the fair value model, or disclosure, if it uses the cost model. Means standard requires that the entity must try to calculate the fair value of that investment property, regardless of its accounting model, whether it applies fair value model or cost model. Because if it is applying fair value model, of course, that information is required to apply this model. But if company is applying cost model, then disclosure of fair value is required in the accounts. And an entity is encouraged but not required to determine the fair value of investment property on the basis of a valuation by an independent valuer who holds a recognized and relevant professional qualification and has recent experience in the location and category of investment property being valued. When measuring the fair value of investment property in accordance with IFRS 13, an entity shall ensure that the fair value reflects, among other things, rental income from current leases, and other assumptions that market participant would use when pricing investment property under current market conditions. When a lessee uses the fair value model to measure an investment property that is held as a right of use asset, it shall measure the right of use asset and not the underlying property at fair value. Next is, after initial recognition, an entity that chooses the fair value model should measure all of its investment property at fair value, except in extremely rare cases where this cannot be measured reliably. In such cases, it should apply the International Accounting Standard 16 cost model. A gain or loss from a change in the fair value of an investment property should be recognized in net profit or loss for the period in which it arises. Next is this. Here are guidelines which tells us how can we determine the fair value, and some other additional information is given in this slide. Cost model. Simply, cost model is the cost model given in International Accounting Standard 16. Investment property should be measured at depreciated cost less than any accumulated impairment losses. An entity that chooses the cost model should disclose the fair value of its investment property. Then is changing model. This is important. Someone asks question related to this area, so I hope that question will automatically be answered. But in case it is not answered, so please feel free to ask it again so that I could specifically highlight that area from the slides or the illustration where your answer is lying. Changing model. Once the entity has chosen the fair value or cost model, it should apply it to all its investment property. It should not change from one model to the other unless the change will result in a more appropriate presentation. International Accounting Standard 40 states that it is highly unlikely that a change from the fair value model to the cost model will result in a more appropriate presentation. So only you can change where you feel that this will result in more appropriate presentation. Transfers. Transfer to or from investment property should only be made when there is a change in use. This is very important. Change in use. Intention is not important. Like management intends to do this thing, intends to change its use. No. In fact, there is a change in use. For example, there should be an evidence. For example, commencement of owner occupation for a transfer from investment property to owner occupied property. Like you rented a building, now you have decided and started using that building as an owner occupied property for your business, for your office, for supply of goods, for supply of services, or for the production purpose. Then is commencement of development with a view to sale for a transfer from investment property to inventories. End of owner occupation for a transfer from owner occupied property to investment property. Because we know that if we have a property and we have not yet decided what to do with it, will it be used as an owner occupied property, or will it be rented, or will be keeping it for capital appreciation purpose? That will become the investment property. So here, if owner occupation is no longer there, then this will become your investment property. Commencement of an operating lease to another party for a transfer from inventories to investment property. So this is the case in case of transfer. Then transfers fair value model. If you transfer from investment property to owner-occupied property, the deemed cost for subsequent accounting will be the fair value at the date of change in use. This is very clear. Second is, if from owner-occupied property, someone asked question, I suppose, related to this area. From owner-occupied property to investment property, the difference between the value under IAS 16 or IFRS 16 at the date of change and fair value will be treated as a revaluation in accordance with International Accounting Standard 16. Let's have a look at an example which explains the last concept. Example is, a business owns a building which it has been using as a head office. In order to reduce cost, on 30th June 2009, it moved its head office function to one of its production centers and is now letting out its head office. Company policy is to use the fair value model for investment property. The building had an original cost on 1st January 2010 of 250,000 and was being depreciated over 50 years. At 31st December 2009, its fair value was judged to be 350,000. How will this appear in the financial statements at 31st December 2009? You can see that we bought this building on 1st January 2010 at a cost of 250,000. It is being depreciated over 50 years. And on 30th June 2009, owner occupation on 30th June 2009, the company rented it out. Okay, letting out its head office. So on 30th June 2009, there is a change in its use. So first of all, what we will do, we shall calculate the carrying value of this asset on the date of change. Like this is the cost, and we shall calculate the accumulated depreciation till 30th June 2009. See, this is the cost from 1st January 2010 till 1st January 2009. 9 years are passed. So 250,000 cost divided by total life into 9 years till this date. So this will give you 45,000 accumulated depreciation. Then for 6 months, we calculated separately. It could have been done over here by instead of writing here 9.5. So this could have given the same figure. But we have calculated here separately. Like for 6 months, 250,000 divided by its life into 6 months, 6 by 12. So this will give you 2,500. This means 47,500. Addition of these two figures is the accumulated depreciation. This is the carrying amount at 30th June 2009. Then we determined its fair value. We assume that this is the revaluation. We revalued it and determined its fair value. So the difference between this figure and 350,000 is the revaluation surplus. This will be treated in accordance with International Accounting Standard 16. So now onward, 350,000 will be the deemed cost for this investment property on 30th June 2009. Mean this property is increased to 350,000. I suppose someone asked question related to this. Hopefully that is answered. Okay.
We have some questions over here.
Okay, we have some question. We can answer it now. Them now.
Abdul Mirza Beg asking, please clarify fair value model exception when it can be measured reliably for one investment property. Then will this be valued on cost model and other investment properties on fair value model?
Please repeat his question.
Please clarify fair value model.
Okay.
Exception when it cannot be measured reliably for one investment property. Then will this be valued on cost model and the other investment properties on fair value model?
Yes. Then that if it is not possible that that you have opted for like fair value model, and for any particular property it is not possible to determine reliably, but there are some guidelines. I'll be narrating that as well. Then you can treat that investment property using cost model, and for the remaining investment property you can use fair value model.
Okay. We have another question from Ravi Kumar.
Yes.
If there is change in the accounting policy from cost model to fair value model at the end of the year, how we will reflect the impact in financials?
Again, if there is a
change in accounting policy from cost model to fair value model at the end of the year, how we will reflect the impact
Ravi,
in financials?
this is the perfect example for that. This is a transfer. This is a transfer. Okay, you want this is a transfer, and you want to treat. Okay, I suppose we are going to discuss this concept in the coming slides. Had it not been the case, we can take up this point. Okay, should I move further?
No. Okay. Some other questions. What if an owner partly occupy the investment property? By Manu, but I don't know to what part.
Manu, what is the question?
What if an owner partly occupy the investment property? This is the only.
Yes, if Manu, if that part is insignificant in comparison with the whole building, then that building will be treated as investment property.
Okay. Mirza Beg asking again, first example, shouldn't its fair value be determined on June 2009?
First example, this is the only example. Repeat what he said.
Shouldn't its fair value be determined on June 2009?
Yes, we are doing the same because this 300. Okay. At 31st December, its fair value was judged to be. No, I think there is small typing error. This is 350,000 on 30th June 2009. That's why revaluation service there. Subsequently, on 31st December 2009, the company will determine the fair value of this asset and adjust this 350,000 accordingly, and the difference will be treated in the profit and loss account. Ravi, I hope you are clear. Please, rest of the members, please note and please make this small correction in this example. Like in it is mentioned alongside 350,000 figure in the example, like at 31st December 2009, its fair value was judged to be 350. No, it should be At 30th June 20x9, its fair value was judged to be. I can make this small correction, and then this will be easy for you to appreciate this point. At 30th June. Ravi, you are correct. Thank you very much. Okay.
Fateh Fakhri said if the fair value decreased in the subsequent years, shall we apply the requirements as in contained IAS 16?
No. You will be reducing this amount, and the difference will go to the profit and loss account. Okay. Transfer fair value from inventories to investment property. The difference between value under ISA 2 at the date of change and the fair value shall be recognized in the profit and loss account. Transfers. When an entity uses the cost model, transfers between investment property and owner-occupied property and inventories do not change the carrying amount of the property transferred, as they do not change the cost of that property for measurement or disclosure purpose. Next is disposal. Simply derecognize, eliminate from the financial statements position an investment property on disposal, or when it is permanently withdrawn from use or no future economic benefits are expected from its disposal. Any gain or loss on disposal is the difference between the disposal proceeds and the carrying amount of the asset. It should generally be recognized in income or expense in the profit and loss account. Okay. Now we move to International Accounting Standard 16. If we have any question, I can quickly answer those questions before moving to IAS 16.
Arsalan Sheikh is asking, we have an office lease for 3 years, which we recognized as a right to use asset under IFRS 16 in our books. I want to know that the treatment of same asset from its owner perspective. Will it be an investment property in his books?
Arslan, is it because you are talking with reference to lessor? Is it operating lease or finance lease? If operating lease, then this is investment property.
Yes.
This is investment property for the owner of that.
Operating lease.
Then this is investment property for the owner of that.
Muhammad Bilal asking, what will be the treatment of revaluation surplus?
See, revaluation surplus will remain there, and on disposal, you can transfer it to the retained earnings.
Muhammad Faisal, he needed to know that 3 days same topic or daily different.
Muhammad Faisal, actually, we are trying to cover standards related to fixed assets. So we started with 23, then we moved to 20, then 40, and now we are going to start 16 along with the interpretation. And tomorrow, I suppose 16 will continue, and whatever time we have tomorrow, we shall be discussing 38 and 36, but not in length, very briefly.
Abdul Basit Kadir, I always have confusion regarding a financial asset and investment property. Both are technically for realization of gains. Please elaborate.
Who is this gentleman?
Abdul Basit Kadir.
Abdul Basit, see, financial asset and investment property. If you apply the criteria which you have just mentioned, like both are meant for gain, so you are right, both are meant for gain. But see, each standard has its own scope. You can criticize, okay, this type of transaction could have been dealt within this standard, or the guideline given in this standard can be applied to that type of transactions as well, though standard scope is not specifically covering those transactions. But financial assets will be covered by IFRS 9, whereas investment property will be treated under International Accounting Standard 40. So earning gain from the transaction is not a criteria which should be applied while deciding about the accounting treatment. It is the scope of that particular standard which will be deciding. Next.
Okay, Aslan Rashid asking, no, sorry. Abid Majid asking, is it necessary that investment property should be in real estate form or tangible form?
Who is this?
Abid Majid.
Abid Majid, of course. Property, tangible. Property, land and building. If you just go back to the definition, you will see that land or building, land and building, or land or building. Yes.
Okay, up to Pasika there. I always have confusion. Again, questions there are repeating. I think we have only one question left from Ali Nach. Please explain transfer of revalued property having surplus in equity form. Equity from IS 16 to IS 40. What will be the treatment of surplus?
I answered this question earlier.
He
On
just
disposal
asked-
of that asset, you can transfer this surplus to the retained earnings.
Okay, Hamid Akram is asking that as per IS 16, if an asset is revalued, first we will reverse accumulated depreciation up to the full amount.
You are right.
recorded
You are
in
right.
P&L.
Yes.
The remaining amount we can book in revaluation surplus reserve. Is this also applicable on investment?
No. Investment property, if you are like using cost model, this question will not arise, because cost model mean you are applying cost model of International Accounting Standard 16. We are talking about if you are applying fair value model, because in fair value model, at the end of each reporting period, you will be calculating the fair value of that fixed asset. Any change in the fair value will be transferred to the profit and loss account. No depreciation, nothing else.
Ali Naksh is asking that whether the revaluation surplus contained in equity should be routed through P&L?
No. On disposal, this is my professional opinion. Those standards specifically does not mention anything so far as my knowledge is concerned. This will be when on disposal of that particular investment property, this revaluation surplus will be directly transferred to the retained earning. This will not be routed through the profit and loss account.
We don't have any more.
Okay. Now, International Accounting Standard 16. So, warm up yourself. Wash your faces imaginary, of course, and so that we could discuss this standard, because at the start of this standard, I would like you to participate in the discussion and in solving small illustration, which should give me an idea that we are very good at so far as 16 is concerned. But of course, this will help us in addressing the gray areas as well in our basic standards. Followed by interpretation. Followed by interpretation 1.
Ali Naksh is asking that if we should account for it in disposals only.
Yes.
Okay. Sukaina Fatima said, can you please Re-explain the transfer from investment property to inventory with the help of example. Also tell its accounting entry.
See, scanner, this is very simple. If you just go back to our earlier slide, here, this one. If you just look at the slide, you can see that very clear. See, inventory has got some value on the date when there was a change in use. And at that point in time, you determined its fair value. The difference between these two amounts will be recognized in the profit and loss. For example, you have a building which was being constructed for sale, and now building is complete, some time is passed. This is your inventory because you are in the business of selling building after construction, and it has got some carrying value, like it has got 10 million carrying value. 10 million, how we reached to this 10 million, of course, labor, material, overheads, all these things were added to calculate this amount of the self-constructed building property, which will be sold to the customer. So 10 million cost is there within this inventory account. Now you changed its use by renting it out to a third party. At this point, you will determine the fair value of this building. If the fair value of this building, whose carrying value as an inventory is 10 million, if the fair value is like 12 million, the difference of 2 million, this like property will be transferred from inventory. Inventory will be credited. Inventory will be credited with 10 million. Investment property will be debited with 12 million, and the difference of 2 million will be credited to the profit and loss. So can I hope it should be clear.
So can I clarify that she is asking that whether the transfer from investment property to inventory should be counted?
Yes, Scanner, fair value of the investment property at the date of transfer will become the cost for the inventory for onward accounting. Of course, the concept of impairment or obsoleteness will apply subsequently, but that will become the deemed cost. Scanner, I hope it should be clear.
Usman Iqbal is looking for Scanner, thank you. Usman Iqbal is asking, in real estate business, those have rental incomes from such properties, should it be categorized as an investment property?
Yes, it should. Okay, I think we can move to the 16 because we have got a lot of work on that. You're welcome, Usman. You're welcome. 16. Okay. First of all, we go for the scope. Scope is very straightforward. This standard does not apply to property, plant and equipment classified as held for sale in accordance with IFRS 5. Biological assets related to agricultural activity other than bearer plants. Then the recognition and measurement of exploration and evaluation asset. This is debt in IFRS 6, or mineral rights and mineral reserves such as oil, natural gas, and similar non-regenerated resources. So this standard will not cover these areas. Further, this standard, however, applies to property, plant, and equipment used to develop or maintain the assets described in B to D. What was B to D? This was B to D. B, C, and D. B, C, and D. Then N An entity using the cost model for investment property in accordance with ISA 40 investment property shall use the cost model in this standard for owned investment property. We discussed this point while discussing ISA 40. Okay. Then is property, plant and equipment. We know are tangible items that are held for use in the production or supply of goods. We have seen this definition earlier in International Accounting Standard 40. Then is this is the same criteria as we apply to any other asset, as we saw the same criteria in International Accounting Standard 40. Whenever you want to recognize an asset, these two conditions should be there. Okay. Just I want to highlight some additional point, like spare parts and servicing equipments are usually carried as inventory and recognized in profit and loss when consumed. However, major spare parts and standby equipments qualify as property, plant and equipment when the entity expects to use them for more than 1 year, or they can be used only with an item of property, plant and equipment. They can be recognized as property, plant and equipment. Next is like safety equipments. Property, plant and equipment acquired for safety or environmental reason qualify for recognition as assets when they enable the enterprise to obtain the future economic benefits from the related assets in excess of those it would obtain otherwise. A recent example in Pakistan, like the government requires a school to buy, to make some security arrangements. They might have bought security equipment, safety equipment, maybe including gun or other metal detector and walk-through gates. So all these items will qualify to be recognized as a property, plant and equipment because they enable the school to obtain future economic benefits from the other related assets. Otherwise, they cannot operate. Otherwise, local government will not allow them to operate. Mean they cannot generate cash flows from their main activity, from their other assets, unless they buy these assets. So these assets are basically enabler. Enabler means without which you cannot generate cash flows from your other assets. Another example is a chemical manufacturer may install new chemical handling processes to comply with environmental requirements for the production and storage of dangerous chemicals. The related plant and equipment will be recognized as an asset because without them, the entity will not be in a position to manufacture and sell chemicals. So these are the two examples which we already know. Okay. Okay, be ready. See, here is a list which we know and which I know hardly any of you is not applying, because from time to time your organizations buy fixed asset, and when they buy fixed asset you have to apply this checklist. This is the checklist. I should not say checklist because this is not exhaustive, but anyway, this is a guideline which tells us what should be included in the cost of an asset. Original purchase price less any trade discount and rebate, import duties and non-refundable taxes. There could be taxes which are refundable that should not be included. Then cost of site preparation, delivery, carriage, inward and handling, installation and assembly cost, directly attributable professional fee for architects and engineers, and then is testing cost to assess whether the asset is functioning properly, net of sale proceed of items. When I see on my right, in fact, on my right side there is a screen which tells me what is in front of you, in fact. The estimated cost of dismantling and removing the asset and restoring the site. There is an interpretation, very detailed interpretation on this point, which we will discuss after International Accounting Standard 16, which is very important, especially for those members who are working in such industries where when they buy a fixed asset, that fixed asset requires restoration and dismantling. And not only this requirement, but also they are using revaluation model. Then there are certain additional guidelines which are not covered in International Accounting Standard 16. Those are specifically covered in Interpretation 1. We shall be discussing that after International Accounting Standard 16. Then if payment for an item of property, plant and equipment is deferred, interest at a market rate must be recognized or imputed unless it is capitalized in accordance with ISA 23 borrowing cost. We have discussed this standard at length in our yesterday session. See, this is a list, but there are few other things which we should have in mind. Number one, administration and other general overhead costs are not a component of the cost of the property, plant and equipment, unless they can be directly attributable to the acquisition of the asset or bringing the asset to its working condition. Directly attributable mean this could have been avoided if we have not bought that asset. Startup and similar pre-production costs do not form part of the cost of an asset unless they are necessary to bring the asset to its working condition. Like you have bought an automatic machine which manufacture this piece of plastic on which there is something is written like ACCA. So that machine automatically manufactures this piece of plastic with this ACCA mentioned on that. When you initially run that machine, after putting the plastic and the colors, two colors, red and white, I suppose, and plastic, initially you receive this output, maybe greater in size or smaller in size, sorry, larger in size or smaller in size than you require. Or you may find that ACCA is not correctly mentioned over here. No, it is mixing with red or things like this, and you keep on adjusting that machine till the time you are able to manufacture your required piece of product. This is all this pre-production cost will become part of your asset. In fact, this cost is necessary to make it ready for use. Without these adjustments, you cannot produce the end result. Thereafter, any cost, you will not be capitalizing that cost. So then examples of costs that are not part of cost of an item of property, plant and equipment are cost of opening a new facility, cost of introducing a new product or services like advertisement, promotions, cost of conducting business in new location or with a new class of business, staff training costs, especially keep this in mind. These are not, in fact, are those costs which should be included in the cost of the asset. Okay, now let's practice this concept. I should not say practice this concept because every day you are practicing. Just to refresh this concept with the help of an illustration, so that I could see that if we are ready for that or not. Okay, we have an illustration over here. Very simple illustration. Like basic list price of plant is 300 million, in fact. because you can see that there is thousands on the top. Okay, it should be in front of me as well. Okay. Okay. Then trade discount 15% of list price. It is better you should download this small illustration because then it will be easy for you to solve this small illustration. Shipping and handling cost, estimated pre-production testing, then is estimated pre-production testing, then is site preparation cost, electric cable installation, concrete reinforcement, yes, on labor cost, additional amount paid. This is incremental. I am telling you, like this is not an apportionment of their existing salary. This is the additional amount which we have paid. The company paid for the plant, excluding the ancillary cost, within 4 weeks of order, thereby obtaining an early settlement discount. Interesting. There is another amount. There is another information. Then is the company had incorrectly specified the power loading of the original electrical cable to be installed by the contractor. The cost of the correction of $8,000, it should be taken as 8 million because all figures are in thousand, is included in the above figure of 14 million. The plant is expected to last for 10 years. At the end of this period, there will be a compulsory cost of 15,000 to dismantle the plant and 3,000 to restore the two different costs. To restore the site to its original use condition, here we shall be ignoring discounting. Calculate the amount at which the initial cost of the plant should be. So it is better because question is simple, but it is lengthy. So it is better you should. Can we download this question from GoToWebinar window?
Yes, people can download it from GoToWebinar.
Please download this question and keep it in front of you so that you should answer it correctly. Otherwise, yes.
These questions are available in the handout sections, contained as a Word document. I think this is named as illustrations. People said, sure we can. Few people are having problem while downloading these handouts. I think they are having problem because of their Explorer. Some people are using Chrome while others are using Mozilla and some are using Internet Explorer. So you have to go to the link, and when you access the link, you can also save it from the file tab at the left most side of your screen. So you can scroll it down and then move to the save as link. It could be downloaded from there, I think.
Because yesterday someone mentioned me that she is unable to download it from GoToWebinar.
Let me share with you. I have opened this same webinar and
No. I agree. I mean, I'm not negating that this is not possible, but because
people are having different default browsers.
So it is. I would suggest that if we could send all this material through email before the start of the webinar, because previously we have adopted this practice and we were not receiving any complaints about this area. You are right. I mean, they may be using different browsers, so this may be due to that particular type of browser. But if this is the case, then I suppose we should mention the more preferable browsers as well while communicating with them about the webinar.
As you know, we receive handouts just a few times before, so practically I think this is might not be possible for us.
Okay, you people are trying this question, please. I am waiting your answer.
Talha Farooq said he has downloaded.
Okay, good.
So we have people who can download these handouts. Okay, Ravi Kumar said just copy the link from one browser to another. It will work and you can download. Thank you, Ravi Kumar.
Repeat what Ravi said.
He said just copy the link from one browser to another. It will work and you can download.
Which browser is preferable? Which browser is?
I think Chrome is preferable.
Chrome.
Even Internet Explorer can outrightly give you an option to save. When you click on the document provided in the handout section, if it will by default open in Internet Explorer, it will straight give you an option to save. Chrome is working fine, Moin Imtiaz. Yes.
So please solve this illustration and give us your answers.
We said Word documents can be downloadable on Internet Explorer easily, while for PDF documents, Chrome is working fine. Sanaullah said 3,13,750. Archibald said
okay, just let me mention the question, answers over here. Okay. What was the answer? What you said?
3,13,750. 750.
750. Okay.
By Sanaullah and 3,02,750 by Archibald.
And 3,02,000?
750.
750. Okay.
Ram Rathan said 3,17,050. 3,17,050.
50. This.
Sadia Aslam 3,10,750.
750. Okay.
Hasiur Rahman 3,12,250.
250. Difference is not material.
Shiraz Sadir was 2,86,600.
2,86,000?
600. Now this is the difference.
Please come up.
Sukiana 3,11,750.
3,11,750.
Usmani Hall 2,09,750.
2 lakh. 2,89,000.
750.
750. 750 is common.
Mariam Alauddin 3,19,750.
3,19,750. Okay, let's come to the correct answer. The correct answer, I appreciate this our member who answered 311,750. This is the correct answer. This is the correct answer. I appreciate.
So Sukaina Fatma is the one.
Yes, Sukaina, well done. But the rest of the people should have answered it. But anyway, let me explain. How we reached 311,750. I have answers over here as well. See here. No. Okay. See 300,000. This will be there. Less this discount, which is 15% of 300,000 because this is trade discount. So you will reduce 300,000 by 45,000. Then you will add 2750. Fine, this will be added. I'll make green, which will be straightforwardly added. Okay, I should have green over here, but it will be difficult for you people to see. Okay, so this will be straightforwardly added. This will be reduced. How much? 15% of the list price, because you have not paid this amount. So this is 45,000. Okay, then estimated pre-production testing will be there. Green, no problem. Maintenance contract should not be there. Why? Because maintenance is like your ongoing repair and maintenance. So this will not be there. Even if it for 10 years or 15 years, this should not be there. Then electric cable installation. See, this 10,000 concrete reinforcement, of course, they should be there. This 14,000 standard says if an amount involves abnormal like expenditure, because it has 8,000 like abnormal expenditure. So we shall ignore that 8,000 and it should be 6,000 while calculating the cost of this asset. Then because you have paid to your labor incrementally, so this will also become part of this. Then we have this 18,000. So this will be added to this cost. Khyam, can you please quickly add up or deduct 45,000 from this figure so that, okay.
Which figures you from?
Okay. 300,000.
300,000
minus
45,000 yes.
Plus 2750 plus 1 to 500 plus
yes.
6,000 plus 10,000 plus 7,500 plus 18,000.
And the answer is
750. So see, so far as this early settlement discount is concerned, this will not affect your cost of your asset, because this is a financing a finance transaction. This is nothing to do with the initial recognition. Okay. Now I hope nobody has any questions so far as these specific figures are concerned.
Adnan Lakhani, what is the right treatment if estimated life of asset ended, but that asset is still in use by the entity and it continues to use it for the years subsequently?
Lakhani, this reflects that entity fixed asset policy is not correct. The method or their estimation of the determination of the useful life is not correct. Of course, that will no longer be depreciated subsequently, but this reflects that entity estimation of useful life is not correct. Next.
Sukaina Fatma, can you re-explain the transfer from investment property to inventory? Okay, that person had already been answered. Shiraz Qadir Baksh. If there was a surplus in investment property in 2014 of rupees 5 lakh, for example, and there is a decline of 2,50,000 in 2015, then we need to reverse surplus in 2015.
Shiraz, which is better, you can send this question through email. Otherwise, we cannot discuss IAS 16. I would ask you to send it through email.
Santosh Kumar.
Don't be a question related to ISA 40, please. I request you people that please send, if you still have any question about 40 or any other standard, so please send it through email. I will try to answer it. Okay.
Santosh Kumar Krishnan, purchase of capital spare. The items are operationally critical. Therefore, these are purchased should this cost be capitalized and depreciable,
Yes.
or should this be held under inventory? Which of the above approach should be taken, if so, why?
If the amount is significant, then it should be treated as property plant. Next.
Okay, Mirza Beg, shouldn't its fair value be determined on June 2009? First example again, I think that was answered. Okay.
No. Take only those questions which are related to, if like we have made those figures green, which should have been accounted for while calculating. If anybody has any question related to this, then we can take that question.
Okay, kindly repeat why 6,000 is taken out of 14,000 for electric cable installation.
No, we have taken out 8,000 from the 14,000. In fact, if we just
so if
it was in fact 14,000. So we ignored 8,000 because 8,000 is abnormal expenditure. Any abnormal expenditure due to mistake, which is not normal, so that should not be included in the cost of your asset. That should be simply expensed off. Next.
No more questions. What about early settlement discount of 3%?
Shiraz, see, you bought an asset and on credit. Subsequently the supplier of that equipment said, okay, I will initially you have recognized that asset. It is not happening when you are initially recognizing that asset. It is happening subsequently, and this is your like a financing transaction. Next.
No, okay, but people are saying to take break now.
Just after another small illustration, then we will be taking a break. There is another small illustration. Please, this is another small illustration. It has not got much detail. Base price 1.05 million, trade discount 20%, early settlement discount taken on the payable amount of the base cost only 7%. Freight charges, this is important, base cost only, freight charges, electrical installation cost, staff training in the use of materials, that is very important. Without that, you cannot run your machine. Pre-production testing, purchase of a 3-year maintenance contract, estimated residual value. Please, you have 1 minute. Once you answer this question, then we can go for break. After taking a question, if you have any related to your answer. Quickly, take 1 minute. You have 1 minute. Quickly calculate this small illustration.
Ramratan said answer is 9,56,000.
Ramratan said 9 lakh. Okay, 56,000. Please come up. It should not take much time.
Atif Bhatt 9,56,000, Abdul Rafi 9,56,000 was Umes, but 9,56,000, Gulvez Asad 9,21,000, Param Mahan Ramya 9,56,000, 11,31,000, Santosh Kumar, Sukena 9,56,000, Usman Iqbal 9,21,000, Sumra Asgar 9,56,000, 9,56,000 by Shehnaz, Shakil Zulfikar, same answer, Fateh Fakri 9,500,000, Mehboob Usmani 9,77,000, Moin Imtiaz 9,66,000.
Okay, I have your answers. So
Salman Yusuf Latif 8,71,000.
Okay, So let's do the calculations. So this will be there. We will start with this figure. It should be there. Of course, we will reduce this with our trade discount. You please keep on calculation. Yeah. We will reduce this 1.05 million with this amount. We will reduce with this amount. We shall ignore it. It has nothing to do. This is a financing transaction. As I explained earlier, freight charges. Okay, this will be added to the cost. Then electric installation cost. It should be added. Of course, it should be. Please keep on. Staff training cost, I specifically mentioned. This will not be included. This will not be included. Then pre-production testing, yes, it will be included. Then maintenance contract will not be included. Estimated residual value will not be included. This is an amount which is in fact, you will receive when you will dispose of at the end of the useful life. We are recognizing this asset now. So this figure has nothing to do with this value. So can you please?
10,89,000.
10 lakh?
89,000.
Okay, let me see, are we ignoring any figure or something like this? No, I think we need to recalculate.
10,50,000.
10,5 minus 210 plus 30,000 plus 28 plus 23,000. 921,000. The correct answer is 921,000.
Whether the trade discount be accounted for 20% or whole?
See?
20%?
20%
Of 2,10,000.
20% of 10,50,000 of the base price. It is mentioned over there.
Okay.
Clearly mentioned that it should be the 20%. Now you can see your own calculation, and if you have any question, otherwise we can go for a separate break. A separate or something, some like refreshment as well.
So it should be no questions are there.
Okay, so we can go for break. Can you please mute it? Okay, now okay, now the next small concept is if you have acquired an asset through exchange. The principle is exchange transaction. Acquired asset is initially measured at its fair value. In addition, if fair value of only one of the assets can be determined, fair value of the asset given up, if fair value of both assets are readily available, unless the fair value of the acquired asset is more clearly evident. The principle is very simple. Like in case of exchange of assets, because we are discussing at what amount the acquired asset should be recognized. The acquired asset should be recognized at its fair value. So there could be fair value of what? Of the asset acquired or the asset given up. If any of these two fair value is available, that fair value can be used. If fair value of both assets given up and acquired are given, then use the fair value of the asset given up, unless the fair value of the acquired asset is more clearly evident. Okay. Next is if there are fair values are not available, then you can use the carrying value of the asset given up to record the asset acquired. I have some illustration related to this. We can see those illustration. Those illustration includes the answer. Okay, these are XYZ Limited acquired a machine, asset acquired. In exchange for a motor vehicle asset given up, cost and accumulated depreciation of motor vehicle was 1.25 million and 0.725 million respectively. The fair value cannot be determined for either of the asset. Carrying amount of motor vehicle is 525,000. We can calculate from here as well. The machine is initially measured at 525,000. This will be the actual. This is the example where fair value cannot be determined for both assets, or there is lack of commercial substance. You can say that it's a similar asset as per the old guideline, similar assets. So you can. I mean, here we are assuming, though, like illustration is not for the similar asset. Here, where you cannot, you do not have fair values of both assets which were exchanged. Simply record the asset acquired at the carrying value of the asset given up. Then is fair value. Okay, XYZ Limited exchanged a car with a carrying value of 2.5 million with MNC for a machine with a fair value of 3.2 million. The fair value of the car is not readily determinable. The machine will initially be measured at 3.2. Mean, in this situation, only one fair value is available. No matter fair value, which fair value is available. Does this mean Does this relate to asset given up or asset acquired? You will be using that fair value for like recording of the asset received, acquired. So this will be the double entry. Then the situation is whereby, like for example, on 31st May 2015, Glove acquired plant with a fair value of 6 million. Exchange for the plant, the supplier received land which was currently not in use from Glove. The land had a carrying value of 4 million and an open market of 7 million. Here we have recognized it at 7 million. This is the example where fair value of both assets available. But because the asset given up is the asset acquired is being valued on open market basis, so that is more clearly evident. So you will be using that. Okay. Depreciation. Here is a small illustration for depreciation. A lorry bought for a business cost 17,000. It is expected to last for 5 years and then be sold for scrap for $2,000. Usage over the 5 year is expected to be year 1, 200 days, year 2, 100 days, year 3, 100 days, year 4, 150 days, and year 5, 40 days. Work out the depreciation to be charged each year under the straight line method, the reducing balance method, using a rate of 35%, machine hour method, sum of digits method. Straight line method, quickly, please. Your answers. Please answer only for first year, no problem. Straight line basis. Straight line basis, your answer. No, please answer. Straight line method, simply.
People are saying
it will
3,000. 3,000. Lots of people saying
3,000, correct. Okay. For each year. Very right. So this is solved. Now come to the reducing balance method. Please tell me the depreciation just for the first year. Depreciation just for the first year. Reducing balance method. Reducing balance. Just first year form. Yes, any answer for first year?
5,250. 5,250.
5,250.
5,950.
5,950.
5,250.
5,250.
Lots of people are saying 5,250. Few people are saying 5,950.
See, here is a small gap. What we forget in reducing balance is that we shall multiply 35% to the cost, 1.7 million, and this is the correct treatment. You will not be reducing this amount by the residual.
How much once I indicated this? 15,000 into 35%.
So the correct answer is 5950. The correct answer is 5950. Only in straight line you will reduce the cost by residual value to determine the depreciation for each year. In reducing balance, the formula is cost into the rate. This will be the depreciation for the first year. So the correct answer is 5950. So this is the reducing balance method. Okay, can you please tell me the depreciation under reducing balance method in 5th year, which is the last year, quickly?
$1,034 by Sinaula.
1034 by Sanaullah.
One person is saying my first answer was 200 days. 5,250 by Amjad Ramzan.
In the 5th year, which is
1972, Muhammad Sohrab. 1625, Fateh Fakhri. Hassan Tariq, 134. Sir, IAS 16 para 55 states that depreciation of an asset begins when it is available for use. That is when it is in the location and condition necessary for it to be capable of operating in the manner intended by management. If company has an asset and it is available for use, but actually it is not used, then from which date should depreciation be charged? Either from the date it is available for use or from the date when it is actually used.
Available for use. Because even if you are not using an asset that is available for use, depreciation will be charged from here.
Okay, Talha Farooq saying, 1643.8 was of 200 days. Hassan Tariq 1650, approximately 1062. MD Ramzan Atif Bhatt 3034, 1062.12 Aslam Rashid, 1062.11 for 5th year. Ravi Kumar 1634, Muhammad Aziz Siddiqui, Fateh Fakhri 1062, Sukaina 3034, Sadia Aslam 1034, Nadia Rahim 1035, Usman Iqbal 1062, 1034 on 5th year.
Okay, I will not comment on this, but anyway, I will be using Word document just to give them the idea, like what should be the answer, because none of them is correct. Like, see, year 1, say what we used, it was in thousands, yes, okay, into 35%. This will give us depreciation first year. First year depreciation is 595. Second year depreciation. Second year depreciation is, of course, the net book value, which will be 7 minus 595 to 0 into 35%. So this will give us 386. Can you please repeat the calculation? Yeah. Just check the calculations. Then is I want net book value at the end of second year, which can be calculated like by this formula.
595,000 is okay.
Minus 595 minus 386. This will give me the net book value at the end of
386,750 is also
0. So multiply it with 35%. This will give us
minus 386,750.
this will give us 251
251,388.
388. Then fourth here. What is the net book value at the end of third year? Please calculate the net book value at the end of the third year. At the end of the third year. Or you can calculate 1.7 million minus all these three depreciations.
Okay.
So this will give us 466. Just confirm it. 46.
466,862.
So this is the net book value. Above I am calculating the net book value in fact. Okay. So this will give us the depreciation of 163.
This will be 163,402.
402. Now in the fifth year, what is the net book value?
The net book value is 303,460.
303,460. Remember, in reducing balance method, last year, we have opening net book value. We will deduct this amount by the residual value. This will give us the depreciation for the last year in case of reducing balance.
103,460.
So this is the small point which you need to remember. So in reducing balance method, though, we need to just remember two things. At the start, while calculating the depreciation, we will not reduce this 1.7 million by the residual value. But in the last year of the asset's life, simply opening net book value minus the residual value will be the depreciation. You will not be applying any percentage. So I hope please keep this point in your mind. Okay. Next is machine hour method. Machine hour method or unit of production method. You can name it other ways also. Machine hour method, unit of production method. There are many other ways. So can you please quickly calculate just for like for first year? Okay. Calculate based on this method just for the first year. See, this is a lorry. For this lorry, machine hour or production of unit or here, number of days the lorry will operate. Here you can see that over its life of 5 years, this lorry will operate 200 days, 100 days, 100 days, 150 days, 40 days. When we add up all these 5 figures, this will give us 550, 590, I suppose, 590 days. These are the days this lorry will operate. These are the machine hour of the lorry. If we just to correlate it with that word, production unit of the lorry. What production unit of a lorry is days of operation. So 590 days are total days this lorry will operate. So in first year, what we will do, we shall multiply 1.5 million, mean 1.7 million minus 200,000 residual value. 1.5 million divided by 590 into multiply 200 days. This will give us depreciation for year 1. If you just go back here, year 1 depreciation will be calculated. 1 point, and we know that how we have calculated 1.5 million. This is net of cost and the residual value into 200 days in first year and total days 290 days. So this will give us the depreciation for first year. And likewise, what you will be doing, you will keep on replacing the number of days. So this will give you like depreciation for each year. So this is basically machine hour basis. Then is the fourth one, sum of digits method. Sum of digits method, in sum of digits method, because in earlier sessions, someone asked about sum of digits method. He said, I forget this method. This method is in fact sum of digits method. Digit method. In this method, you add up the numbers of the years. 5 years, so you add up 1 plus 2 plus 3. If life is 7 years, so then 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 7. So this will give you like 15. No, depreciation for first year will be, this is the first year. Your depreciation will be again multiply 5 divided by 50. So this will give you depreciation for your first year. Second year depreciation will be, can you please turn it off? Okay. Because it is so in second year this will be 4, and this will become 4, and in third year we shall change this figure as 3. This will give us 300,000. And then in year 4, 2. This will give us 200,000. And then the last year, 5th, we will make it 1, and this will give us 100,000. I hope it should be clear. See, if we conclude our depreciation discussion, except reducing balance, in all other 3 methods, straight line method, unit of production method or machine hour method, and sum of digit method, you apply your calculation or factor to the net of cost and residual value. Like you can see that here we have used 1.5 million, and in sum of digit method, and here we have used 1.5 million. In straight line method of depreciation, we have used 1.5 million. But in reducing balance method, we have not reduced the cost by the residual value. Number 1. Number two, in all other 3 methods, if you add up all the year, in all other 3 methods, we have not we did not subsequently treat the residual value. In reducing balance, simply in the last year, simply reduce the opening net book value by the residual value in order to calculate the depreciation for the last year. So this was just a reminder for these methods. Of course, you people are doing at your presence. Okay, next.
Should we take questions?
Do we have any questions?
We are having questions from our previous discussion. Hamid Akram is asking the estimated cost to dismantle an asset can be capitalized, as this is just an estimate. What if there is material difference in the estimate and actual cost that is incurred at the end of the asset?
Who is the gentleman?
Hamid Akram.
Hamid, we shall be discussing it in interpretation after IAS 16.
Another question, Baba Khatak. I am a CFO in a hospital and has recently purchased a unique bespoke medical equipment. The equipment is the first of its kind, brought and installed in the country. The supplier has charged me nothing for the equipment, but has bounded me to purchase medical consumables to be used by the said equipment for the next 2 years. The quantity of the consumables to be purchased are not predetermined. It could be 2 million or 20 million worth.
Tell him send the specific situation through email.
How would I determine the cost of the said equipment, given the fact that there is no active market of this equipment?
Name of the equipment, and because there is no such thing as free. So anyways, send the medical equipment and what are the other details, what are the consumables. Through email, I'll be answering him specifically.
Okay, Dr. Kritik, you have to share your question over email of the trainer.
I suppose. Okay, next is, these are the answers. You can see that over here. And these will be available with you people. These are the answers, so which will be available with you people, just to remind you that what are the methods. Subsequently, if expenditure improves the asset or is for replacement part, otherwise that subsequent expenditure should be expensed out. So this is a principle which we already know from. Okay, major inspections, we know major inspections will be capitalized and then depreciated over the period to the next inspection. Similarly, complex non-current assets, a complex asset has a number of separate components, each with a separate useful life. An obvious example would be a ship or an aircraft. A ship can have internal fittings which require replacement several times during the life of the hull. The landing gear of an aircraft will require replacement after a specified number of landings. International Accounting Standard 16 requires each separate component to be separately depreciated over its useful life. When a component has to be replaced, the existing component is de-recognized and the new component is recognized and depreciated over its useful life. International Accounting Standard 16 gives the example of a furnace which may require relining after a specified number of hours of use. When relining takes place, the old lining will be de-recognized and the new lining depreciated over the number of hours of use before next replacement. This should not be confused with the replacement of small parts, which should be described as repair and maintenance and charged to the profit and loss account. So this was the concept related to the complex asset. Like here is an example of complex asset of an aircraft, whereby you can see that the total cost of this aircraft is 169.3 million. 169.3 million, and this aircraft has been segregated into its major components like exterior, cable fitting, engine, and this will be depreciated separately. Exterior is being depreciated separately, cable fitting is depreciated separately. Likewise, engine is being depreciated separately. Then is measurement after initial recognition. We know that there is a cost model after recognition as an asset. An item of property, plant and equipment shall be carried at cost less any accumulated depreciation and any accumulated impairment losses. Then there's a revaluation model whereby after recognition as an asset, an item of property, plant and equipment whose fair value can be measured reliably shall be carried at a revalued amount, being its fair value at the date of the revaluation less any subsequent accumulated depreciation and subsequent accumulated impairment losses. Revaluation shall be made with sufficient regularity to ensure that the carrying amount does not differ materially from that which would be determined using fair value at the end of the reporting period. So this is the revaluation model. Measurement after initial recognition, revaluation model. In revaluation model, when there is a revaluation, what are the steps involved? In fact, standard has given two methods. One whereby you restate the accumulated depreciation proportionately with the change in the gross carrying amount of the asset, so that the carrying amount of the asset after revaluation equals its revalued amount. So this is one method. And the second is, here is an example for that method as well. Like a building owned by a company is carried at 20 million, cost of 25 million less accumulated depreciation of 5 million. The company's policy is to apply the revaluation model to all of its land and buildings. A current valuation of this building is now rupees 26 million. See, this is the carrying value and this is the current valuation. What will be the entry for this? Before and after. So if you just ignore this after, this is the cost 25 million, accumulated depreciation 5, and carrying amount 20. You will gross it up. How? 26 new value divided by 20. Multiply this factor with the cost as well as with the accumulated depreciation. And your entry will be, because the difference between 32.5 and 25 is 7.5, asset will be debited with 7.5 and accumulated depreciation credit with 1.5 and revaluation surplus with 6. Revaluation surplus with 6. So this is the double entry in case of method 1. This is after initial recognition. Now let's move to the method 2, whereby what you do, there are a couple of steps involved in method 2. Determine the accumulated depreciation up to date of revaluation. Determine accumulated depreciation up to the date of revaluation. Number 1. Number 2, then transfer accumulated depreciation as at date of revaluation to fixed asset cost account by passing this journal entry. Then step number 3, calculate the revaluation surplus or deficit. If you simply use this formula, you will be reaching the right figure, like revaluation surplus if AAA, and revaluation deficit if the amount is negative, it is denominated by BBB. Revalued amount minus net book value at the date of revaluation. This will give you the revaluation surplus. Step number 4, you will pass this entry in case revaluation. In step number 4, there are further few situations. So in step number 4, if there is a surplus, revaluation surplus, and this is the first time surplus is there, you will be passing this entry with the total amount AAA. In case the fixed asset was previously revalued, in that case, then there could be two situations. One is the fixed asset was previously revalued upward, and the other is the fixed asset was revalued downward. Then pass this entry. If previously revalued upward, pass this entry. Fixed asset debit and other comprehensive income credit with revaluation reserve. Previously revalued downward, then as at revaluation date, calculate carrying amount of the fixed asset under cost model, then pass the following entry. This formula is very clear. Like fixed asset will be debited with the revaluation surplus, as I have mentioned here, AAA. You will be calculating the amount which need to be credited to the profit and loss account, and that will be calculated, and that amount is this DDD. This will be calculated carrying amount under cost model minus actual carrying amount. Actual carrying amount mean the carrying amount which is at the date of revaluation. So that is this is the amount, and this amount is simply if this asset is being accounted for using cost model, what could have been the value of this asset. So you will reach to this figure. So the net of these two figures will give you the DDD. The balancing figure will be other comprehensive. There could be balancing figure, there could not be. But anyway, this could be balancing figure. There are other ways as well, but practically, if you apply this approach, you will be reaching the right figures. Then, if there is a deficit, in case the revaluation is carried out first time, pass the following entries. Just the BBB, we denominated the deficit with BBB, fixed asset credit with BBB, and profit and loss account debit with BBB. In case the fixed asset was previously revalued, then there could be two situations. One is the fixed asset was previously revalued upward, other is the fixed asset was revalued downward. Previously revalued upward, pass the following journal entry, which is other comprehensive income debit, and profit and loss account credit, and that is also debit, and credit fixed asset with the total amount, and then you will debit other comprehensive income, where CCC is up to balance in the revaluation reserve account, but will not exceed BBB. And if there is a balancing figure, this will go to the profit and loss account. Then is previously revalued downward, pass the following entries: profit and loss account debit and fixed asset credit. Okay, these were the entries, and these were the steps which you can use, and you can use this slide as a reference while making these entries. I hope and I suppose that you must be having your own ways of calculating this, but the ultimate effect and the ultimate entries are given on these slides. Okay, revaluation model. Revaluation reserve can be transferred to retained earning in the pattern in which the asset is being depreciated. Can be transferred mean if you have a policy, if you don't want, standard does not require it. Standard allows you to do this. On disposal of fixed asset, the balance in revaluation reserve will be transferred to the retained earnings. After any revaluation, subsequent depreciation expense is charged with reference to revalued amount. The original cost will no longer be a reference for this purpose. Okay. Before we move to interpretation 1, if you people have any question related to our discussion on IFRS 16, please feel free to ask, because after your question, we shall be having Maghrib prayer break.
Some people have already posted their questions.
Okay.
Burhanuddin asking if a company is using UPS for backup of electricity, then there are two components of it, that is battery and UPS equipment. Should we depreciate them separately or consider them as a single item?
See, batteries cannot be fixed asset if they are not dry batteries. See, normal, dry batteries can have like life more than 1 year, but if you are using dry batteries and UPS life is more than those batteries, and then you can separate it. But look at the materiality and the significance. But you can separate them. Like if life of the UPS is 10 years and you have to replace your battery after 3 years, every 3 years, so you can like separately recognize these components of the complex asset.
Same question, I think, in different scenario stated by Burhanuddin again. If part of a compound or complex asset is capitalized, is replaced, how to treat it, whether it should be expensed or capitalized?
Again, repeat the question.
If part of a compound or complex asset is replaced,
see, if that particular part is a significant part and that is already separately recognized, of course, that will be a disposal of that part, and that replacement will become the acquisition of that part. Please, next.
Fateh Fabri asking you to give advice. With one of his clients, there was a refinery with different major components. They had not split it, the components since about 20 years and capitalizing any additions. They could not value the components. Can you please?
No, Fatih, they, in fact, the objective of segregation is like you have segregated your complex asset into A, B, and C. And A has different life, B has different life, C has different life. So if you have not segregated, this means all different life assets are being depreciated using a single life. So this is wrong in itself. So far as the capitalization of the significant part is concerned, that is correct. But the calculation of the depreciation, I suppose, could be significantly incorrect. Fateh, I suppose it is clear.
If there is a policy of depreciation, fully charged in the year of purchase and not in the year of disposal, how it affects depreciation charges using reducing balance method?
Again.
If there is a policy of depreciation fully charged in the year of purchase and not in the year of disposal.
Not in the year of disposal.
So
this means in the second last year you will be recognizing whatever net book value except the residual value in the second last year. The whole amount will be charged as a depreciation.
Mohammed Assis Siddiqui, kindly elaborate on staff training cost. As you mentioned earlier, that the adjustment of machine to finally achieve the required result.
No, you are right. Asjad, I deliberately commented like this, and that is truth. Without staff training, you cannot run a machine. And why we have not capitalized. In fact, as per the definition of the asset, you must be able to control that asset. Standard says you cannot control the behavior of the employees. There could be a debate, Asjad. There could be a debate like we can control, we can make an agreement for 3. No. But standard says no, you cannot control human beings. So that's why they can leave, they can resign and they can go for another organization. So staff training cost is specifically disallowed. Yes.
Mohammed Asad again asking, kindly confirm us whether machine odds and sum of digits methods are still relevant depreciation methods under IAS 16.
Asjad, ISA 16 gives you the principle. And what is the principle? Principle is depreciation expense is basically a pattern of consumption of economic benefit. If you feel that you will be consuming those benefits equally over the life of the asset, you will be using straight line method. If you estimate or if you judge that no, in the start of the life of an asset, we will be obtaining more benefits than the later years, so you will be using the reducing balance method. Similarly, if you feel that no, the benefits are linked with the production of that asset. If we produce more in a particular year, we have consumed more benefit of that particular asset. You can go for the unit of production method. Similarly, it is only a pattern that need to be decided by the company or based on their past experience, based on their future projections of sale and the usage of that asset. So it is not like this method or that method. It is principle based basically approach of the International Accounting Standard 16. Yes.
Okay, I think we have another question. If a company has leased hold property and the company incurred capital expenditure over it, how to treat that expenditure?
Same way as you do with your own asset. I mean, if you incur expenditure on right of use asset, which will improve that asset. And what is the improvement in fact? Improvement is either this will result in an increase in the life of that asset. I mean, a right of use in that case, like previously you entered into a lease agreement for 5 years, and now somewhere towards the end of 5th year you decided to extend it, and you made an expenditure to expand. So this is your subsequent expenditure on the right of use asset. So this will give you another 2 years. So this you can capitalize that amount in your right of use asset.
Usmani Pal said, item purchased for development of asset, oil storage tank. Some purchase already used and some remain on site, and company may be acquired. So asset value will be including purchase items.
No. He will have to tell
That
the whole story, the scenario of his company through email, so that I could evaluate the true picture of the situation before answering it. We can have now a small break for prayer and some refreshment as well. Okay, thank you. Please mute it. Okay, just IFRIC 1, decommissioning or dismantling cost, revaluation model. Specifically, we shall be focusing on revaluation model, but we will be discussing cost model also. How to account for dismantling and restoration cost? Because after initial recognition, in initial recognition, you made estimates of restoration and dismantling cost, but subsequently, during the life of the asset, these estimates can be changed materially. So how can we treat those changes? For example, these changes could be due to estimated timing and or the estimated amount. Like you initially estimated that 20 million will incur at the end of 10th year, but subsequently due to changes in circumstances, when you revised your estimate, you found that now this will cost 25 million. So there could be a change in the amount, and there could be a change in the timing of that outflow, because time value of money is involved. If timing of that outflow is changed, that also affect your estimate. And the third one is if there is a change in the discount rate. Mean any change in estimated timing, or any change in estimated amount, or any change in the discount rate will change the measurement of your decommissioning and restoration cost. So how we will treat this change? It is not difficult area, but in fact, few of you may have to apply this concept. So that's why this is not very popular concept. Okay. First of all, we discuss about cost model. You have an asset and you are using cost model to account for that fixed asset. And there are dismantling and restoration cost associated with that asset, which were initially recognized during initial recognition. So the treatment will be changes in liability, mean decommissioning and restoration liability, shall be added to or deducted from the cost of the related asset in the current period. This means if your decommissioning and restoration liability is increasing, so you will increase that, but the second effect will go to the asset. Simply remember this. In case of cost model, because treatment is different when you are applying cost model and when you are applying revaluation model. So we are discussing cost model. Under cost model, any change, the second effect of any change in the decommissioning and restoration cost will be sent to the fixed asset, except only in one situation. I repeat again, changes in the liability shall be added to or deducted from the cost of the related asset in the current period, except The amount deducted from the cost of the asset, shall not exceed its carrying amount. If a decrease in the liability exceeds the carrying amount of the asset, the excess shall be recognized immediately in profit or loss. If a decrease, so this is the principle related to cost model. If the adjustment results in an addition to the cost of an asset, the entity shall consider whether this is an indication that the new carrying value amount of the asset may not be fully recoverable. This is another aspect, but so far as its basic treatment is concerned, we have seen in A and B. But if there is an increase, so you can look into the recoverability issue as per International Accounting Standard 36. You can calculate its recoverable amount, and if there is an impairment, you can treat that asset in accordance with International Accounting Standard 36. Let me go back to previous slide. So if I just repeat, changes in the restoration and dismantling liability shall be added to or deducted from the cost of the related asset in the current period. Simple principle. Second effect of increase or decrease of restoration and dismantling liability will go to the fixed asset account. Only you need to take care, like when amount deducted from the cost of the asset shall not exceed its carrying amount. Very basic principle that you cannot make your asset negative. When like your restoration and dismantling liability is decreasing, you will be debiting that amount, that account, and you will be crediting the fixed asset account. But make sure your fixed asset should not become negative, because an asset can be zero or positive, it cannot be negative. If a decrease in the liability exceeds the carrying amount of the asset, the excess shall be recognized immediately in profit or loss. Okay, let's see an example, an illustration. It is already available with you people, and that is okay. This is the example, illustration. It says an entity has a nuclear power plant and a related decommissioning liability. The nuclear power plant started operating on 1st January 2000. The plant has a useful life of 40 years. Its initial cost was 120,000. This included present value of an amount for decommissioning of 10,000. The risk-adjusted rate of discount is 5%. The entity's financial year ends on 31st December. On 31st December 2009, the discount rate has not changed. However, the entity estimates that as a result of technological advances, the net present value of the decommissioning liability has decreased by 8,000. The entity uses cost model under IAS 16. This line is very important because while making adjustment for any change in the decommissioning and restoration liability, check which model is being used. Excuse me. Which model is being used? Here they are using cost model. Here they have calculated for us the present value of the decommissioning liability that is reduced by 8,000. So our entry will be, because liability is reducing, debit decommissioning liability, credit fixed asset. The entry will be So this will be the recommendation. If we have any question, we can take it down because we have entered into a unpopular area. So sometimes even an easy concept need to be explained.
Burhanuddin asking if a company has leasehold property, for example, a building for 5 years paying monthly rentals of rupees 1,60,000. The company has decided to build third floor over it and incurred rupees 1 million on it. How to account for this capital expenditure when it does not affect the rental payments?
If it does not affect the rental payment.
He's asking a leasehold property, a company having a leasehold property, building for 5 years, paying monthly rentals of rupees 1,60,000 per month. The company decided to build third floor over it and incurred rupees 1 million. How to account for this capital expenditure when it does not affect the rental payment?
Who is this gentleman?
Burhanuddin.
Burhanuddin, see, the building is owned by your lessor. If he is allowing you to build another floor against, and he will not be charging you any additional rental. Normally, practically what happens if your lessor is not incurring this cost, then that is basically compensated through the rentals. So you will have some sort of like substance within that transactions to like increase your asset or affect your asset. It will not be like simply like this, like we have a building and this is a rented building. We built it, we built a floor on the top of that building, an additional floor. So there is no increase in the rent, of course, because it is not built by your lessor. You are adding it to it. This cost will be capitalized. Why? It is just like you are owning that floor at least for 5 years. So this is your benefit from that asset. Benefit is you are receiving that benefit. So you will be, because now you can accommodate more people. Now, like you can start some sort of like services or supply of goods or like some sort of production from that flow. So that will become your like your asset because you will be benefiting from it. Benefit is not only in the form of cash. Burhan, I hope it is clear.
Mohammed Aziz Tiki, what about those parts of the machine who have more than 1 year of life, useful life, but are not an integral part of the machine? Should we also segregate the part?
No. Insignificant parts are normally treated as a repair and maintenance expense whenever they are replaced. No, it is only significant part.
Can you tell us the pattern of benefits consumed under sum of digits method and machine hours method specifically? Tell us the pattern of benefits consumed.
Pattern of benefit consumed. Suppose I wrote it over here, I suppose. How the pattern was consumed. Okay, let's go back. See here, you can see that in case of sum of digit method, benefits are being consumed in the pattern the lorry is being used. Like we used for 200 days in year 1, so this is the depreciation. In year 3, we used lorry for only 100 days. So the depreciation is this much. Whereby in year 4, we used lorry for 150 days. So the depreciation expense goes up because we linked the benefit with the usage, machine hour basis. Then here this pattern is like reflects that this lorry will give you more benefit in the start of its life, like reducing ballast method, mean the same pattern, and lower benefit, mean less benefit in the towards the end of its life. I hope it should be clear. I mean, you can see very well the benefits which are being consumed. Next.
What about those parts of the machine? Again, asking same question has been asked time and again. How I-16 describe the concept of componentization of property, plant, and equipment.
See, I gave you the example of like aircraft, ship. Third example was the furnace. Furnace inner lining has a different life and its body has different life. Similarly, aircraft, you have seen 3 major components. Similarly in ship. So, but significant mean the asset overall, within in relation to the overall value of the asset, that asset has got a significant value in relation to the overall value.
More question.
Okay, so this was our cost model and how we can calculate. Before moving to the revaluation model, which is a little complex area, I would request you people, can you please run the feedback pop-up?
Okay.
Because we are only left with 2-3 minutes. So during this time, you can fill the feedback pop-up. Now they can see only the pop-up question.
Pop-up questions, yes.
Can you ask someone to?
Okay, I will manage it.
No problem, no problem. Take your time.
All the participants are encouraged to give us the feedback, as this is very relevant for us. So far, only 24% people have voted out of around 400 members or attendees. So more people are encouraged to give us feedback as early as possible.
Hello. All right.
So guys, we are going to end this poll now. Okay, so we have 30% people who are saying that the poll is excellent. Our feedback is excellent. 56% are saying that it is very useful. 13% saying it is good.
Thank you very much for your valuable feedback. And as you know that all questions cannot be answered, and sometimes there are practical situations which requires more information. And if we start taking that information during this session, so this will become irrelevant for the other members. So I would request to those members who have any specific question or any question related to an aspect which is not discussed during this session. So please send me an email. My email address is, as you know, all people, I suppose. My email address is basically I can mention it here. Okay, I should write it here. My email address is abubakar@bakertilly.com. So this is the email address. Mr. Khayam, you can write in a comment where so that and that is sent to all the participants if they have any questions.
I have sent it this message through chat box to all the participants. They can pop up their chat box and can access your email from.
Okay, thank you very much again for your participation. And tomorrow we will continue from the point where we are closing this session. And tomorrow is the last session for the accounting for fixed assets. Thank you very much. Allah Hafiz. Bye.